Hey everyone, happy Monday. Welcome back to my channel. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona. Every Monday, I'm here with another market update on what's going on in the Phoenix housing market. And if you're new here, make sure you subscribe. You don't want to miss these updates every Monday. I also post other information about living in Phoenix and Phoenix real estate throughout the week. So hit that subscribe button and the bell for notifications. Thank you so much for coming back. If you're not new here and watching me every Monday, I hope this information is helpful for you, and I'm always available for questions. Feel free to call, text, or email me about anything. I've got my information in the description below. So let's talk about what's going on in the Phoenix real estate market. I will say thank you to the Cromford report as always, because I get a lot of my information from them. I'm a subscriber, and they are hyper local, looking at the Phoenix metro market specifically, which is so helpful for me to know what's going on and educate all of you on that. But it's been interesting lately because we've had some changes in the market. The last few weeks I've been able to report on some things other than just a seller's market, on, and things continue to change. So I want to start today by talking about the fears of a recession and the fears of a housing market crash or home values going down, because that seems to be the hot topic as things are changing. So I've got my little whiteboard here, starting with this section here where it says recession doesn't equal a housing crisis. And so I think this is an interesting visualization of what has happened over the last 40 years of recessions that we've gone through. And you'll see that there's only 2 times when home values actually went down when we had a recession. And I think everyone is really used to talking about 2008 because that was the most recent experience and also the most horrific for everyone. And so it's just becomes synonymous, recession and housing prices crashing. It's, people kind of associate those two together, and it doesn't always mean that's what's going to happen. I'm not going to go into the differences between today and 2008 in this video. I can do another video about that. But this is just an interesting visualization, in my opinion, where you can see, which recessions actually led to home price decreases and which didn't. So we still had appreciation in these other times. And so point being, just because we're entering a recession or going to or are already in one, depending on who you listen to, doesn't mean that your home value is going to crash. So now let's look at what they're forecasting for appreciation throughout this year. So this is from Keeping Current Matters. There are a bunch of different organizations here that have forecasted where our home prices are going to go this year. And on average, all of them together, it's about a 9% appreciation rate is what they're saying. But everywhere from 6.2%, the Mortgage Bankers Association says that, to Fannie Mae saying 10.8%, and everything in between. So none of these organizations are saying that home prices are going to go down. They are still forecasting additional appreciation this year, just at a much slower rate than where we were at in the past. For Phoenix, over the last year over year, home price appreciation has been somewhere between 25 and 30%, depending on how you are looking at it, which month over month. So 10% feels like a big decrease, but really 10% is so excellent to have that type of appreciation annually. So we'll see what it ends up being, but 9% is what Keeping Current Matters is averaging based on all of these other organizations' forecasts. I have 121 months here. Our home prices have increased and continued to appreciate over the last 121 months consecutively. So it's a pretty insane statistic. It might be a record. I think it is. So just again, to put that in perspective, we've seen one heck of a lot of appreciation. So, even if we go flat, it's not the worst thing in the world after 121 months of home price appreciation. So that's our picture of kind of the larger market. Just wanted to touch on that because continue to hear questions and concerns about recession equal home price decreases, and that's not necessarily the case. So also, in the same vein here, talking about predictions. So the Redfin chief economist came out and made this statement at a conference last week and basically just said, this is where we're at right now, and it is reasonable to expect this is what could happen. So she says that recently we were thrust into hyperdrive by historically low interest rates and finally begins to slow this year after the Federal Reserve raises rates to fight inflation, which we're absolutely starting to see that slow down right now. The number of homes will slow down or homes sold will slow down and by 10% as the housing market weakens. Prices don't fall nationwide, but prices do slow, dropping from 20% to perhaps 5% annual growth by the end of this year. So she's expecting something a little bit more drastic than the previous slide. Home builders that are spooked by the slowdown, they will scale back their construction. And all of this comes to a head down the line when the renewed demand comes back and we still don't have enough inventory and we do this whole thing all over again. So I don't know. What are your thoughts? Do you think that's feasible? Do you think that's a reasonable expectation? I'd love to hear what you guys think in the comments below. My thoughts, it's definitely a reasonable expectation. I think once we get through all of this, I think we did learn from 2008 not to overbuild. So especially with the supply challenges that we have right now, I just don't know that we're ever actually going to catch up to where we would need to be to have an oversupply. And so I think we're going to be pretty cautious on that building side of things, especially if our demand really slows significantly. We definitely don't want to be in that position where we've overbuilt and no one wants to buy these homes. So I feel like we learned that lesson, I hope. And so I could see us really not catching up during this slow time, and then as things change and demand starts to spike, we're just back to the situation we were in before with a lack of inventory, and we kind of go through another phase of big appreciation. Maybe not as crazy as this time, since we wouldn't be in a pandemic again, fingers crossed, but might be back into that cycle. So I thought that was interesting. I wanted to share that with all of you. So let's drill down a little bit and see what Cromford is saying this week. So the latest indicator that they've been watching and calling out as something that we need to watch is the listing success rate. So this is the graph of listing success rates. You'll see I actually have 2005 on here, 2021 and 2022. And what is a little bit eerie about this chart is where the trajectory of the 2005 line is headed and where we're at in the yellow here with 2022. So, I'm not saying that this is going to be exactly the same. And like I said before, factors are very different, but this is definitely something to watch. So the listing success rate is measuring how many homes are listed for sale at the beginning of a month and how many are actually closing or not expiring or being canceled. So that's kind of the big factor that we're looking at. How many are actually successful in selling once they're listed? And right now we're at about 90%. So it's still really high, but we were, hugging 2021 for a while here, and now we're starting to taper off. So not sure if that's going to continue to go downward or if that's just going to kind of hang out around, just under 90%, but definitely going in a different direction and starting to go down. In 2005, we were at about 63%, which means 1 in 3 homes were actually successful in selling. So it's a pretty big difference from where we've been over the last few years to where we would have to go for that to happen. But it's kind of crazy to think about only 1 in 3 homes actually being successful in selling. So we need to watch this very carefully, because if the listing success rate continues to drop, that's another indication of where we're headed. And if people are not buying homes and we have a lot listed for sale, then that will eventually affect home values. So we're going to keep an eye on this and see where this 2022 line decides to go. Now let's talk about the Cromford Market Index, everyone's favorite thing to follow. If you're new here, the Cromford Market Index is a proprietary algorithm that the Cromford Report has come up with, and it measures supply and demand in our market. They've been using this since the year 2000, so the Cromford Report CMI actually was showing signs of some pretty big changes back in 2005 and indications that they were a little bit worried about before everything kind of burst. And so we always follow the CMI because it has proven to be very trustworthy over time. And essentially, if the CMI is at 110 or above, it's a seller's market and prices will continue to increase. And below 90, it's a buyer's market and home values can go down because we have more homes for sale than buyers. And so this week we're at 315. This has been going down every week pretty significantly. Just for fun, I went back to my previous videos from earlier this year just to see kind of where we were at. And in February, we were around 470. So we've come down quite a bit in the last few months here. One of the big changes that we've seen is demand dropping. So at 98.3, that means that we're like about 2% below normal, although 90 to 110 is technically normal. So demand is normal-ish, but it's getting below that 100 mark. So starting to go away from being normal and being just kind of low. So we'll have to watch that, but that's changed quite a bit. And then our supply index is 31.2, which means that we're about 70% below normal for supply. So still really low there, but keep in mind, this has come up like maybe 10 points since the beginning of the year, because I recall us being in the very low 20s, maybe 21, 22. So supply has steadily increased, and in the last month has increased quite a bit faster than it had in the past. So what's going on right now is we have an increase in supply of homes coming on the market, and we have a decrease in demand of people wanting to buy homes. So that's starting to create a more balanced market. We don't have this complete polar opposite of no homes to buy and a ton of people who want them. So the ratio of people, offering on homes to how many are available, that's starting to get a little bit smaller, which is what is affecting those list price cuts that we're seeing. So people are listing their homes too high, not getting enough bites, and starting to decrease that listing price. And we're going to start to probably see the cost for the seller go up a little bit. They may have to make some more concessions on the sale, give the buyers some credits for repairs, maybe pay for a buyer's closing costs, something like that. Those negotiations are going to start to be a little bit more apparent as we continue in this direction. So that's where we're at with the overall CMI. This chart here that I always show is every major city throughout the Phoenix area and what their respective CMI is. Now, this has gone down about 15%. All of these cities went down at least 15% when we compare month over month. And on average, though, all of these cities have gone down about 24%. So when you look at the average, because some have gone down way faster and higher. Previously, that average was about 20.5%. So we're seeing quite a bit of acceleration in how quickly these cities are going down. So until we see a smaller number than 24% when we compare month over month, that means that we're just continuing in this pretty fast-paced decline of these CMIs for every city. Now, I have a few of these circled here: Avondale, Gilbert, Cave Creek, and Queen Creek. All of those have seen the most significant drops in their CMI. So 30% for Avondale, Gilbert 34%, Cave Creek 30%, and Queen Creek 36%. So that month over month change is pretty high compared to what we've been seeing in the past. So those cities are the most affected right now. If you're a seller in those cities, you are basically losing leverage every day that this starts to come down. You're starting to lose that leverage to get a really high price from buyers, just because there's not either a lot of buyers or you've got a lot of competition with more supply coming to market. So that's where we stand with the CMI for every city. I know you guys love to see that. So hopefully that's helpful for you to see where you're at in your location. Now, for visual effect, I wanted to share the Cromford Market Index here on a graph so that you can see what we're doing right now in 2022. We're that yellow line, and 2021 was the blue line. So what we did last year is we did start to have this come down. I don't know if you guys remember, if you were watching my videos last year, but in the summer, we really started to see our demand come down a little bit, and therefore the CMI was starting to come down, but then we just coasted for a while, and then we started to go back up, and started to go back up quite a bit when investors started coming in and buying a ton of properties, and that increased our demand. Supply never got any better, so that's why the CMI went back up. Now, this time we're going down, but I don't think we have that saving grace of the investors this time around. Things are definitely different with the climate, interest rates, just the recession concerns, and the economy overall. So we're starting to really see this effect of the CMI going down, and it's clearly going down quite a bit faster and more steep than it did last year. But I wanted to also compare what we're seeing today to 2005 because people love to talk about that. So the green line is 2005. You can see this started to come down as well, but really not quite as steep as where we're at today, which I find interesting. Obviously it was different circumstances, but just wanted to give you an idea of what we're seeing today versus what we saw in 2005. This just kind of came down pretty steadily, but obviously it was much lower, right? The CMI at that point was getting below 100, which that's when home values do start to go down. So we still have a long way to go to get over here. That was ugly, but you know what I mean? We still have a long way to go to get over here. But I don't know. Is this going to continue to go this way? Are we going to coast? Are we going to go back up? It's anyone's guess. It's really hard to say. I'm not in the business of making predictions. I'm just here to give you the information that I have on hand, and you can infer from there what's the best choice for you, knowing where we stand today. So for visual sake, wanted to share the CMI, where we are today, and compare that with 2005. Finally, I did have someone ask about sharing rental data, so I just wanted to briefly touch on this. Where we're at for May, we're $1.34 per square foot on average for monthly rental prices. And you can see we've kind of stabilized here a little bit. We were going up quite a bit with rental rates, and then as rental supply has started to come onto the market more and more this spring, we've started to see those rental rates just kind of flatten out a little bit. Now, I am curious if this is going to change again with interest rates increasing as much as they have been. All those folks that are priced out or have decided they're not interested in trying to buy in this market or buy for the price they have to, maybe they will go back to renting, and maybe that will absorb some of that extra supply. We'll have to watch that and see what happens with the rental market. Haven't seen the effects of anything like that yet, but for now, rental rates are kind of stable, still very high, but we're not climbing like we had been before. So I hope that information is helpful for anyone interested in rental info. But that's all I got this week, you guys. I hope that you enjoyed that. If you have questions specifically about any of this information, you can reach out to me by call, text, or email, or I have a link in the description below for you to set up a time to chat. I also have a link to check your home value, because if you've been considering selling, we may or may not be at the peak of price right now. Again, I don't want to make predictions, but from what I can see, things are starting to change pretty drastically. So if you've been considering selling, now might be the time to capture a really great price for your home before things soften a little bit. And if you're a buyer, although interest rates are high, they're not as high as they've been historically, and your competition is starting to fall around you. So it might be a great time to seize this moment and find your property. Thank you so much for following me and subscribing and watching this video. And I will be back next week with another market update. I'm Caitlin McKegg with the Desert Dreamers team at HomeSmart.